One more minute just to let some people join in, and then we will start our webinar. Well, I'm going to get us kicked off. Thank you all so much for joining us this afternoon. Again, my name's Jonathan Boyskin. I am Executive Director of the Highest Foundation, and I'm thrilled that we have this opportunity to present this webinar this afternoon. The Highest Foundation was recently established, and it honors the generosity of friends and supporters who share a dedication to providing vital services to refugees and asylum seekers around the world. Members of the Highest Foundation Legacy Society have prioritized advocating for refugees and displaced people's fundamental human rights through a planned gift to the Highest Foundation or by including the foundation in their estate plans. Members of the Highest Foundation Society are part of a select circle of donors whose philanthropy and foresight will be uniquely recognized as part of Highest's century-old history, ensuring that our shared mission will endure for years to come. I'm thrilled today that we have a terrific conversation and discussion with Joe Bull, who we will be introducing shortly. Our agenda for the conversation will include, I'm going to introduce Neil Moss, who is a member of the Highest Foundation board, and he will make an introduction of Mark Hetfield, Highest's CEO, who will provide an update on Highest and its impact around the world. And then Joe Bull will provide a presentation on planned giving and charitable gift annuities and creative ways for folks to support the foundation. So I am thrilled to introduce Neil Moss, who's a member of the foundation, the Highest Foundation board. Neil was a board member of Highest itself as well from 2008 to 2018. He is a past chair of the board of directors of Hillel, the Foundation for Jewish Campus Life. He has chaired 2 Hillel presidential search committees, in addition to its $200 million campaign for Jewish Renaissance. Neil is also a registered investment advisor and chairman of Capital Investors Advisory Corporation, a wealth management firm he founded in 1971. Neil earned a BS in engineering from Case Institute of Technology and an MBA from Harvard Business School. Neil's parents were assisted by Highest in the mid-1930s when they fled to the United States, and I'm thrilled to have Neil as a partner on the foundation board. Neil, I'm going to pass it over to you.
Thank you, Jonathan. Hello, everyone. It's now my pleasure to introduce Mark Hetfield, the president and CEO of Highest, formerly known as the Hebrew Immigrant Aid Society, the 120-year-old organization dedicated to serving refugees and asylum seekers around the world. Mark first joined Highest in 1989 as a caseworker in Rome. He has worked for the U.S. Immigration and Naturalization Service, the U.S. Commission on International Religious Freedom, a large law firm as an immigration attorney, and has held multiple roles at Highest over the years. Mark was appointed president and CEO of Highest in 2013. He is a frequent commentator and writer on refugee issues on television, radio, newspapers, and other media. Mark holds both a Bachelor of Science in Foreign Service and a Juris Doctor degree from Georgetown University, where he is also earning an MBA. I've worked with Mark for many years and have always found him to be the consummate professional and equally important, a terrific guy. Mark?
Thank you, Neil. And you're a terrific guy too. Thanks for that introduction. And it really is exciting to be here at this really kind of a launch of the Highest Foundation, which has been a dream for many years. We're all spending our time on trying to raise money to support the important work of HIAS today. But what the foundation does is it supports the work of HIAS for the future, which is really important for us as a 121-year-old organization. Next month, HIAS celebrates its 121st anniversary. We were founded on the Lower East Side of New York City to help Jews who were fleeing the pogroms of Russia and Eastern Europe. And when I joined HIAS in 1989, our work was pretty similar. We were still focused largely on New York, but also around the world, helping Jews who were fleeing largely the former Soviet Union, the former Russian Empire. And we were really thinking when I joined HIAS in 1989, 1990, that it wouldn't be long before HIAS would be able to close its doors because our work was finally coming to a close. The Iron Curtain was crumbling before our very eyes. There were no longer Jews in captivity. And we really thought that our mission had been accomplished and we could move on. Unfortunately, though, the world went in a different direction. The refugee crisis after the collapse of the Soviet Union around the world just grew worse and worse to the point today where there are more forcibly displaced persons around the world than there have been at any time in human history. We know that it's not going away anytime soon. Our work is as important as it's ever been, and we have a role to play, even though now we like to say we used to help refugees because they were Jewish. Today, we help refugees because we are Jewish. We bring our Jewish values and our 120 years of experience helping refugees to the table. And now we're even once again operating in Europe, helping refugees who have fled the conflict in Europe, in Ukraine, find safety in Moldova, in Ukraine itself, in Poland, and in Romania. In addition to the important work that we're doing across Africa, in Israel, helping displaced Israelis right now, as well as asylum seekers from Ukraine, Eritrea, and Sudan, and from about a dozen countries in Latin America and the Caribbean, helping with the multiple refugee crises that they're facing of displaced Venezuelans, Nicaraguans, other Central Americans, and Colombians. So our work is far from done. We will have a long future ahead of us before we can finally say that our work is no longer needed, that the Jewish community no longer needs a refugee agency to represent it and to help Jews when they need our help. And in fact, one of our biggest concerns today are Iranian Jews and other Iranian religious minorities who are in Iran, and HIAS is dedicated to facilitating the safe departure and emigration to freedom for those who want to leave. So that's an ongoing operation that we've been doing for many years and remain committed to. In the United States, we have grown significantly over the last few years since the Biden administration really prioritized that this country should be a country that welcomes refugees once again. So we now have refugee resettlement partners consisting mainly of Jewish family service agencies in 27 cities across the country, in 19 states. And where we don't have an actual resettlement agency partner resettling refugees, that's a Jewish family service agency. We work through welcome circles, through volunteer groups who form these private sponsor organizations that are now permitted and encouraged under the current presidential administration to welcome refugees into their communities. So we are more engaged than ever, and we know that we have to continue this work into the future until finally we reach that time when there are no longer people who are forcibly displaced. We are operating in 24 countries around the world right now, and it's really your support and the ongoing support of the foundation that ensures that we'll be able to continue that work into the future. So I'm so grateful that you have the interest in HIAS that I have and that all of us have in terms of continuing its life-saving work as the Jewish community's agency for protecting refugees, no matter where they are or who they are. Thank you. Back to you, Jonathan.
Mark, thank you so much for your comments and your thoughts and your partnership. The Highest Foundation was established to fund an endowment, to seed an endowment in support of Highest, and we're grateful on behalf of our donors to provide those resources to Highest in perpetuity so that it can do its work. And we hope that this will continue for a long, long time because the need is very much there. I'm thrilled to make an introduction as the next part of our webinar to my colleague Joe Bull. Joe is the founder and principal of Philanthropy Advisory Council. With 39 years of experience in the philanthropic arena, Joe has held senior advancement leadership positions at Carnegie Mellon University, the Nature Conservancy, the Columbus Zoo and Aquarium, and Wilmington College. Joe also provided over 16 years of service to his alma mater, The Ohio State University, primarily as director of planned giving, and has also held gift planning positions at Duke and North Carolina State Universities. He is currently the president of the American Council on Gift Annuities and was the 2005 board chair of the National Association of Charitable Gift Planners. As such, Joe is only the second person ever to have held the top leadership position at both of Charitable Gift Planning's professional organizations. Joe was a member of the Planned Giving Today editorial advisory board for 15 years and is admitted to the Ohio and North Carolina bars. I'm thrilled to ask Joe to present today on charitable gift annuities and how they work. And I know you're all going to be experiencing a wonderful presentation from Joe. Just one technical piece before we launch into Joe's presentation. After he has presented, we'll have an opportunity for questions. If you want to place them in the chat, feel free to do so throughout the presentation or after, and he and I will come back at the end of his presentation and answer as many of the questions as possible. Joe, over to you.
Thank you, Jonathan, very much. And thank you, Neil, and thank you, Mark, for your really thoughtful words. I am going to share my screen and start the presentation, right? Maybe, here we are. And as Jonathan said, and as you saw, we are going to talk about charitable gift annuities today. And I know many of you have charitable gift annuities, either with the Highest Foundation or with other organizations, but it's always good to kind of start from scratch and see, make sure that we all have a common understanding of what they are and how they work. So here is how a charitable gift annuity actually works. You take a person or two people, usually oftentimes it's a husband and a wife, or sometimes it's just an individual person, and then they contribute liquid assets to a charitable gift annuity with an organization, and that charitable gift annuity is a contract. It's an irrevocable contract. If you have annuities maybe with Prudential or New York Life, or you pick some insurance company, they're very similar in how they work and the rules that apply to them. It's just that there's a charitable component to them, unlike those that you get from commercial issuers. So once the charitable gift annuity contract is created, it pays at least annually. Most people get their payments quarterly. Some people get them annually or semi-annually, but the general cadence of most people is to get them at the end of every calendar quarter. You get a set percentage, and we'll talk about that percentage. That percentage never changes. It is what it is from the day you take it out until the day that you're gone. And then the payments can be for your life, or for your life and somebody else's, or for other people's, but no more than 2 lives. It's the maximum that the IRS allows is 2 lives. And towards the end of the presentation, we'll talk about who those payment recipients might be able to be. And those payment recipients are known as annuitants. And so at the end of the annuitant's life, the residuum, that's the amount of money that is left in the annuity, goes to the Highest Foundation for the purposes that you work with Jonathan on establishing. Now, one other thing that we want to establish pretty early on is that the minimum gift annuity amount at the highest foundation is $20,000, and the minimum age for an annuitant is 60. And we'll come back and talk about that again towards the end of the presentation. So as I said, it's a very simple contract. It's 2 pages. And oftentimes the second page is the signatures and maybe the final paragraph. It's a very, very basic, simple contract. Once you establish a charitable gift annuity, part of the income you receive every year is tax-free. And I'll explain that a little more as we get into this. The annuity payments are backed by all the assets of the charity. So there is a really level of security and safety behind those gift annuity payments. Once you establish a charitable gift annuity, you are able to take a charitable income tax deduction in the year you establish the gift annuity, and the amount of that deduction is based on an IRS formula. If you want to know more about the IRS formula, we can talk on the side and I can explain it to you. But like many things, it's got a fair level of complexity to it. There are over 1.5 million charities in these United States, but only 4,000 of them, little more, little less, actually issue charitable gift annuities. So not every charity issues them, nor should every charity issue them for some of the reasons we'll talk about. There's an organization, and Jonathan referenced them earlier, the American Council on Gift Annuities. Little bit of historical background. Back in the 1920s, there were a couple organizations that went out and hired actuaries to do their gift annuities. The actual first charitable gift annuity was issued by Yale University in the 1840s to the famous American painter John Trumbull. If you can remember that picture, that painting of the founders around the table signing the Declaration of Independence that's in the Capitol building, or Washington crossing the Delaware, a lot of those revolutionary paintings that well know were painted by John Trumbull. And John Trumbull gave the remainder of all of his works to Yale University in exchange for an annuity. So that's the first one that we know of. So then that goes back to the 1840s. So you fast forward to the 1920s, and there were some organizations that had gone out and hired actuaries and were really beginning to have some level of success with that. Other charities saw that success, and oftentimes there's a lot of copycat things going on. And if you think about the go-go 1920s, everybody was chasing it. And all of a sudden, a lot of charities were issuing gift annuities without any kind of actuarial basis in them. And so there became almost like the old-fashioned gas wars, if you're old enough to remember those, where charity A will give you 5%, and charity B will say, well, I'll give you 5.2. Then charity A comes back and says, well, I'll give you 5.4. And there was all of this going on. And the New York Attorney General was actually going to shut the practice of gift annuities down. And the few organizations that were really trying to do this properly created the American Council on Gift Annuity to bring some sanity to it, to make sure that donors were safe and secure, and knowing that if they took out a gift annuity from an organization that followed ACGA rates, it would be safe and sound and actuarially firm. And so the main purpose of the American Council on Gift Annuities is to publish maximum rates for gift annuities. The vast majority of organizations in the country follow them. There are a few that don't still, but the vast majority do. ACGA has outside actuaries, and we always have had an actuary as a member of our board of directors. And so we have a professor of actuarial science from the University of Notre Dame, who's currently the ACGA actuary and sitting on our board. And so this is a very thoughtful and, again, almost a 100-year-old process, right? The other thing that ACGA does pretty regularly is it monitors state regulations, because each state there is not a federal law on charitable gift annuities. It is at the province of every state. And as you might guess, there is a wide variety of state regulation and state monitoring of it. And ACGA keeps track of all of that so that the charities can be on top of it and donors as well. So ACGA rates as of 1 month and 5 days ago or 7 days ago, 8 days ago, actually went up. And here is a chart that shows what those rates are as of January 1 of this year. Now, you can see I have a one life rate, and the parentheses here is what the 2023 rate is. And so you can see that they've gone up substantially across the board, almost a full percent in some cases, and in some cases more, right? And so if you're 75 years old, and you wish to take out a charitable gift annuity from the Highest Foundation, that charitable gift annuity will pay you 7%. If you took that same annuity out in 2023, it would have paid you 6%. Now, that doesn't mean that the gift annuity rates are always going to go up. As you might guess, over the first 20 years of this century, ACGA rates actually went down a couple of times. We had the downturn because of the tech bubble. We had the downturn of the Great Recession in 2008. So ACGA rates actually have gone up a couple of times in the last 2 or 3 years. And it's the first time they've gone up in almost 2 decades. So they're very closely monitor what's actually going on in the economy, what's actually going on in investment circles. And that way it also then provides safety and security to both the charity and to the annuitant. Additionally, we issue rates so that like 2 people can do it. A husband and wife could do it. Partners could do it. You could set up a gift annuity for your 2 children, let's say. And so here's what those rates look like. And you may say, why are these rates lower than the single rates? Actuaries will tell you that 2 people live longer jointly than 1 person does. And that does make some sense. And so that's why those rates are lower, because actuarially 2 people live longer than 1 person does. So we also do a survey when we raise our rates, and we compare our rates against a basket of commercial annuity issuers, New York Life, Prudential, et cetera, et cetera, et cetera. There's half a dozen or so that we monitor, and we kind of take a composite average and then compare those rates at different ages to what the ACGA rates are. Now, you will see here that we have 60 male and female across the board. And you'll notice that I only had 1 rate on the previous slide. If you go back, there's only 1 rate here. ACGA rates are unisex. So male or female at age 70 would receive a 6.3 annuity, male or female, et cetera, et cetera. Commercial annuities are issued based on the gender of the annuitant. And so that's why we show this. But you can see that ACGA rates are actually incredibly competitive to commercial annuity rates. And there's a charitable gift involved. So it's not like you're giving up a huge amount of economic benefit by doing a charitable gift annuity versus doing a commercial annuity. They're very, very sound and very, very competitive. So here's an example of a charitable gift annuity with a donor using cash. And the donor is 75 years old, and the donor makes a $100,000 cash gift on Groundhog's Day last week. The reason I have $100,000 in here is that if you want to go back and look at these slides later, it's really easy to divide that. So if you say, oh, I only want a $50,000 gift, you take all of these numbers in this chart and divide them by 2. Or if you say, oh, I want to do a $200,000 gift, you take all of these numbers and you multiply them by 2. And it's really easy to kind of follow and do the math on your own to kind of figure out how that might work for you. So that's why I use $100,000. And so a charitable gift annuity based on the new ACGA recommended rates at age 75 is 7%. The IRS, part of the calculation of all of this is The IRS has a actuarial table that they use, and the IRS estimates that a 75-year-old has a life expectancy of 12.4 years. And I'll explain why that's important in a minute. And so a 75-year-old would receive a deduction for this gift annuity of $43,000 in change, and that is usable in the year that the gift annuity is established. And it follows the same rules. If you use cash, it's up to 60% of your adjusted gross income with a 5-year carry forward for anything that's unused. We're going to talk about using a gift of stock. At that point, it's only 30% of your adjusted gross income. All those normal charitable deduction rules that you're familiar with apply to the deduction of a charitable gift annuity. It's just that the calculation, you don't get to deduct $100,000 because you're going to get the annuity payments. The IRS has the calculation and says we're only going to allow you to deduct $43,000 for that. Now, let's look at the chart. So if we do this on Groundhog's Day, that means we basically have 11 months of this year. And you can see there's tax-free income and the ordinary income and the total $7,000 income, but it's not $7,024 because we're missing a month, right? So again, at 12.4 years, that gets us to into 2036 of your life expectancy. And you can see that the largest portion of the gift annuity payment is actually tax-free. And if you did a commercial annuity with Prudential or New York Life or whoever, it's the same kind of rules. The way the IRS sees that is some of your annuity payment is actually return of your original principal, and you can't get taxed on return of your own principal. And so that's why it's tax-free. But they calculate this based on your life expectancy, so that if you live beyond your life expectancy, you get rid of the tax-free income. It's all taxable, but you've outlived your life expectancy, so that's a good thing. So that's how it works with a cash gift. You can also use appreciated stock to fund a charitable gift annuity, and it's the same circumstances. A 75-year-old donor, $100,000 of stock. That stock has a cost basis of $60,000. The gift annuity is created on Groundhog's Day of this year. That gift annuity will pay 7%. Again, the annuity is based on the age of the annuitant, so that's 75. That doesn't change. The charitable deduction does not change. It's the same charitable deduction. And the life expectancy does not change because it's a 75-year-old. However, what happens is the change is how you account for your income every year. So because you're using appreciated property, your capital gain is divided over your life expectancy and returned to you ratably. So if you compare the two charts, the ordinary income stays the same across the board. The tax-free income goes down slightly, and that is replaced with capital gain income. Now, in the pecking order of things, tax-free income is obviously best, but capital gain income is better than ordinary income because your capital gain rate is much smaller than your ordinary income rate. So it's not necessarily a bad thing. It's just that's how it is accounted for when you do a gift annuity with appreciated stock. And again, if you live beyond your life expectancy, it is all ordinary income. Many people own CDs. And Joan is actually someone that I have worked with for a number of years. She's a wonderful person and incredibly philanthropic to a number of organizations. Lovely, lovely person. She's all by herself, never married, doesn't have any siblings. And so she has to really pay attention to her finances. She held a significant amount of CDs, one just for the security because you just never know. And I don't want to need a bunch of money and have the stock market be down. I just want the safety and the security of knowing that I've got these CDs here if I ever need an influx of cash. Well, at 77, she said, I still need it, but I don't feel compelled to have as many things in CDs as possible. I already have an endowment set up at this organization, and I'd like to do more. And also, it'd be nice to have a little more income because I get no income out of my CDs. So what did she do? When one of her CDs came due, rather than rolling it over to a new CD, she took the cash from the bank and set up a charitable gift annuity. Now, at age 77, her ACGA rate was 7.4%. So she is going to live 11.1 years according to the IRS. So that means that for the first 11 years of her gift annuity, she's going to receive almost $5,000 a year tax-free, and a little over 2,400 of that will be taxed as ordinary income. Now, if you think about it, she was getting $0 from those CDs. They were just sitting there. So her income from those CDs went from 0 to 7,400. And the residuum of that is going into her already established endowment. And she gets a charitable deduction because the organization, the gift annuity payments are backed by the assets of the organization. She still retains a fair amount of security that income is going to be there every year as long as she lives. And she gets a charitable deduction. Now, Joan also owns a significant amount of United States savings bonds. If you're familiar with savings bonds, you know there are only two types of savings bonds that you can actually buy today. One is the Series EE that has a fixed stated guaranteed income. If you buy a EE bond, it is guaranteed to double over 20 years. It will continue to pay income. It will continue to grow for another 10 years beyond that. But if you hold the savings bond beyond that 30-year period, it's still there and it's still fine and it's no problem. It just won't grow anymore past 30 years. Series I bonds are actually keyed to the interest rate, right? There's a base guaranteed amount, but then the income is then varies quarterly based on what's going on in the economy. So that income could go up, that income could go down. So there's a little bit more of a market play in the return on Series I bonds. Again, they only last for 30 years. And if you hold them longer than 30 years, you do not get any income. So Joan had been buying U.S. savings bonds along with her CDs for a really, really, really long period of time. She had some U.S. savings bonds that were more than 30 years old. She was not getting any more income growth out of the savings bond. So she cashed in $100,000 of her U.S. savings bonds, and she did the same thing. She created a charitable gift annuity with those savings bonds. It had the exact same benefits as the gift annuity that she established with her CDs. Same, none of these numbers are all the same. Again, her income goes from 0 to 7,400. She still has high security, but CDs are generally taxed. You generally pay tax on the interest in your CDs every year as they sit there. You do not pay tax on your U.S. savings bonds until you cash them in, and you are taxed on the growth. So if you bought $100 of U.S. savings bonds and you cash it out and it's worth $250, you have to pay tax on that $150 growth at the time that you cash it in. So that's something that she had to pay attention to, and her tax people had to pay attention to, that, okay, she cashed those in. The growth at her savings bonds was part of her gross income for that year. Just something, it's not a big deal. It's just you have to pay attention to that. So last year, the president signed into law a new bill that allowed you to take some money from your IRA and create a charitable gift annuity. Many of you are familiar with the concept of a qualified charitable distribution, and the rules for the gift annuity are very, 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 very similar. So you have to be over 70 and a half. And it has to be from your IRA. It can't be from your 403B or your 401k. If you want to do this, you have to roll money into, you have to roll your 403B or part of it into an IRA. It has to come from an IRA. So you have to be 70 and a half or older. You can do this in 1 calendar year only. You don't have to do it at one point in time. You can establish one gift annuity in January, another one in June, another one in October, whatever, but it has to be within the same calendar year, provided that you don't exceed $50,000. The maximum amount that you can do a gift annuity with is $50,000. So the majority of people that I have seen do these do pick the number and just do it, whether it's 30,000 or 50,000. I don't see a lot of people doing like 20,000 here and 20,000 here and that kind of thing. It's pretty much done, but you have the ability to do that. And I have seen people do multiple gift annuities to different organizations, but it has to be within the 50. Now, if you have an IRA and your spouse has an IRA, you can take your 50 if you're both over 70 and a half. You can take your 50 and your spouse's 50, and you can create a $100,000 charitable gift annuity. The law allows that. Now, you can only set this up for the gift annuity to pay income to you and your spouse. You can't have it go to your sister or your children or your grandchildren. It can only come to you and your spouse. We went through pretty painstakingly earlier how if you did a cash gift that a lot of the income in over your life expectancy would be tax-free. The IRS has said in this law, because you took a tax deduction for the money going into your IRA up front, we're not going to allow you to have tax-free income on the way out. You know, it's, remember that old commercial, you can pay me now or you can pay me later. That's the way the IRS has always viewed retirement plans. We won't tax you while it's growing, but when you take it out, that's when we're going to tax it. And so 100% of the income from that gift annuity will be taxed to you as ordinary income. There will be no tax-free income out of this annuity. It does count towards your $100,000 QCD annual limit. So if I wanted to make just a regular gift to the Highest Foundation from a QCD, I am limited to $100,000 a year, but I can do $100,000 next year and $100,000 in year 3. I can do it every year, but I can only do my gift annuity once, and it's only at $50,000. But that 50 counts against my annual limit, and it also counts against my required minimum distribution. So if my IRA, it requires me to take out $60,000, I could do a $50,000 gift annuity to the Highest Foundation, and that counts against the 60 that I must take out of my IRA. So it's just a different way of funding it. Some people find it incredibly convenient to do that. And they were going to use a QCD anyhow, and they think, well, this is a good idea. I'll do a gift annuity. So that's a brand new thing that we're allowed to do. There's another type of a gift annuity called a deferred gift annuity. And what that is that the payments on that gift annuity are deferred, and they begin at a point in time in the future that you fix. So I could set a gift annuity up today and say, I want those payments deferred until March 31 of 2027. And the gift annuity would sit there, and it would grow. And then in 2027, I would begin to receive my payments. So here's how that works. Let's say a lot of people use the deferred gift annuity as a retirement plan asset, retirement income supplement, right? So I'm 62 years old. And again, I'm going to do a gift on Groundhog's Day. I'm going to wait for that gift annuity to start paying until I hit 72. So it's going to grow for 10 years. At age 72, it's going to pay me 10.5% of that $100,000. Now, that $100,000 over 10 years is going to be worth a whole lot more than $100,000. And there's, as I said earlier, the ACGA rates contemplate a specific amount of growth. And that's how this ends up working out. So I get a charitable tax deduction of $54,000 for doing that. And I take that charitable deduction this year because I set this up on Groundhog's Day. Now, so let's go out 10 years. I hit 72. I'm going to get $3,100 of tax-free income, $7,300 of ordinary income for $10,500. Now you'll see what's interesting is on the other ones, the tax-free income was significantly larger than the ordinary income. It doesn't work that way because of the presumed growth is not your principal. So you're getting paid on money that the gift annuity has earned, not your original principal. That's why your tax-free income is slightly less. But you still get tax-free income. And if you live beyond your actuarial life expectancy, it all becomes ordinary income. But again, you've got the bonus that you've lived longer than the IRS thinks you're going to. So there's a variation on this, and it's a flexible start date. So rather than having a specific point in time in the future, March 31, 27, it's I would say I'm going to set up a deferred gift annuity. The earliest I can take my payment is March 31 of 27, but I reserve the right to not take it then and take it at any point in the future as I want to. And the IRS has said that's perfectly valid. So here's how that works. Same gift, 62-year-old donor. The deduction is the same. The deduction is taken this year. But let's say I wait 10 years to flip the switch on it. No, this is the same numbers you saw on the earlier, but let's just say I wait 12 years or 14 years or 16 years. You can see how much my income grows the longer I wait. And there's actually a chart in the gift annuity that lays out if you wait each year, how much it is. And so that you will know exactly what you will be receiving from your gift annuity when you decide to flip the switch and turn the annuity payments on in the future. It really is helpful. This is really helpful for people in some retirement income planning because they can wait and turn it on when they need it the most. So the question then becomes, we talked about this earlier, who could be an annuitant? Well, typically it's the donor, or the donor might set one up for a spouse, or it's a two-life with the donor and the spouse. That's your typical gift annuity. But there are other annuitants that can be. I have actually worked with a couple of couples where they used a charitable gift annuity as an alimony supplement, not really a substitute, but an alimony supplement. I have worked with people that have set these up for their children or grandchildren. This takes a really long time. It's a really long deferred gift annuity. There are better vehicles for children or grandchildren than a gift annuity, but some people do it. The whole concept is I would rather give my children and my grandchildren the apples and not the tree. I worked with a gentleman in Jacksonville, Florida, a number of years ago. And he said, my stepson is a spendthrift. If I give him $1 today, he's coming back next week asking for $2 because he spent the first $1. He has no ability to manage his money whatsoever. I will not give him $1 of principal, but I do want to provide him income for his life. And he set up a series of deferred gift annuities. Now, his son at that point was 58. So his son was older. And he set up a series of deferred gift annuities to provide income for his son. So he knew that the principal of his gift annuities will ultimately go back to help fund his scholarship at the organization I was working with. But yet he provided his stepson a supplemental income for the rest of his life. I have worked with people that are assisting their aging parents to pay for skilled care facilities. And so they will set up a gift annuity, and the income from that gift annuity will help cover the costs of their skilled care. I've also worked with people that have had businesses and they've had long standing loyal employees, and they have set up charitable gift annuities again as a retirement income supplement to thank those people for their long and loyal service, and then also provide a gift to the fund that I have at whatever organization. So those are the kind of things you could do with a charitable gift annuity that make it really pretty flexible and helpful to people. You also could use some of your gift annuity income to make a current gift to Highest, right? You could have Highest Foundation keep some of that money in your annuity until you actually need it. And you can then, okay, for the first 2 or 3 years, you keep some of the income. And then in year 4, you call Jonathan and say, Jonathan, I think I need all the income this year. And that's perfectly fine. It works really, really well. Here's an example. Let's go back to my friend Joan, who had the CDs and the US savings bonds. You remember her tax-free income was nearly $5,000 and her taxable income was a little over $2,400. So she keeps her tax-free income and she either authorizes the foundation to keep the taxable income or she takes the income and then turns around and writes the Highest Foundation a check. It's the same. It works the same way either way. So she gives back her taxable annuity payment and keeps her tax-free payment. For that $2,400, she has to receive it as income because it is income from her annuity, but she also gets a receipt for the $2,400 gift. So to a certain extent, it's kind of a tax wash to a certain extent, to a large extent. But so a lot of people find this is a really good way of supplementing their current giving at a period of time when they don't need all of the income from the gift annuity. Again, let's go back and we know that if you would like to set up a gift annuity with the Highest Foundation, the minimum is $20,000. And you have to be 60 years old or older to be an annuitant for that. Now, I was a fan of the Better Call Saul series, and that was set up so that if you're in trouble, you call Saul the lawyer. Well, in this case, you better call Jonathan if you want to have some information about gift annuities and other things related to the foundation. Here's the number that you can reach him at and his email or address as well. Jonathan would be more than happy to talk with you and work with you to help fulfill what it is you would like to do. Now, Jonathan, do we have any questions? We've got about 12 minutes left.
So Joe, thank you so much. That was such a creative presentation and wonderful ways for people to think about both their values in supporting Highest Foundation and Highest in perpetuity through a planned gift, through a gift annuity. So I do have a few questions here that came over, and if anyone does have questions, please do add them into the question box, which you could find by hovering your mouse at the bottom of the screen. One is, why do you get tax-free income from this sort of gift? How does that work?
The easiest way to say it is because the IRS says you get tax-free income. That's the easiest answer. But if you really wanted to dig down as to why that is that the way that the tax code is written for annuities, and again, we all know that one of the stronger lobbying groups in Washington, D.C. is the insurance lobby. And so, a lot of these things are set up to help encourage people to set up annuities. And so the way the accounting is done is that the annuity is actually more than what the fund is earning every year, so that when you get your annuity, it's partially interest income, but it's also partially a return of your original principal. That's how the accounting of that is done. And so if you get principal returned, you can't get taxed on money that was your money in the first place. And so to the extent that it is deemed to be return of your original principal, that's where the tax-free income comes from. And then the way it's set up in the charitable gift annuity world is you can only get that. They figure that out over your life expectancy. And so that's why it's done that way rather than however long you live. And because, and then if you live beyond that, it all becomes ordinary income.
Thanks so much. So a question, can we talk about how the use of qualified charitable distributions to reduce your taxable income while partially satisfying your required minimum distribution? And how
Say
that
that
might
again.
work.
I think I know what the question is, but say that.
Sure. Can you talk about the use of qualified charitable distributions to reduce your taxable income
Oh,
while partially
sure,
satisfying
sure,
your required minimum, your
sure.
RMD?
So I think you know that, when you reach, it used to be 70 and a half, and it's now going up. And I think by the time I actually get there, it's going to be 74 before you have to take your required minimum distribution. And some of you are already required to take it, but if I think right now it's 73 is what it is. But at some point in your early 70s, the IRS has said you just can't leave your IRA money sitting there. You have to start taking money out. You're required to. That's your required, and there is a formula. That formula was just redone too, so that it also means there's a little bit less of the required distribution, so that if you live longer, there's still money in your IRA. So the required minimum distribution is an IRS calculation of the minimum amount that you have to take out. So when you take it out, you actually have to claim it on your 1040 as ordinary income and pay income tax on it. If you make a qualified charitable distribution, a QCD gift to the highest foundation, that money is not, you do not claim any of that money as taxable income. It ends up being the equivalent of like 100% charitable deduction for your gift is what is actually the fundamental equivalent. Because if I make a $50,000 QCD gift to the highest foundation, that would have been $50,000 that I have to pay taxes on, and it doesn't even show up on my income. It's as if it never happened. So it's a really, really, really tax efficient and tax savvy way of making a gift, if you can afford to do it.
That's a great answer, Joe. Thanks so much. So I want to just talk for a brief moment about how one would fund a gift annuity through the Highest Foundation, because the process is quite simple. In fact, there's a very basic application form that we would fill out. We would need some identifying documents that show the age of the applicants. There's obviously a transfer of funds over to the foundation. And then there's as Joe said earlier in his presentation, there's an agreement that is established between the donor and the foundation. And then there is a disclosure statement that just talks about how the gift annuity works, as well as an illustration, of course, that we share with you, so you could see all the benefits of the gift annuity over the decades that it will be providing benefit to you. And then ultimately, the reason for making this kind of gift is, your belief in Highest and the foundation, and your interest in supporting the work that Highest is doing around the globe. So I did want to ask this another question that did come up here is, and maybe you could just explain from your perch on the American Council on Gift Annuities, is how are the rates set? How does that process look?
Sure. Again, we actually hire an actuary to help us. And we have an actuary. So there are two components of the rates. There is the kind of the life expectancy component of the rates, and then there is what is the economy, what is the investment economy doing, and what is that, what is that going to do? The recommended return for a pool, I guess I should take one step back, is so if you were to set up a charitable gift annuity with the Highest Foundation, there is a pool, a gift annuity pool, just like an insurance company pools all of its assets for investment purposes. So your gift annuity is not individually managed. It goes into a pool, and like anything else, the larger pool has more flexibility than your smaller individual account does. And so when your gift goes into that pool, the ACGA has a recommended mix of investments, and I think it's It's not even 60-40. I think it's 60-40 bonds, 60 with the bonds and 40. The idea being we have to have security to make sure that the income is paid, and we have to have security that there is going to be a gift to the charity on the back end. So the investment returns on that go into the HGA calculations are very conservative, a very conservative mix. And if you really if you pay attention to these kind of things, if you follow the ups and downs of the 10-year treasury, that gives you a good indication on ACGA rates going up or ACGA rates going down. And so again, 10-year treasuries are very safe and secure, but they don't, it's not like investing in Intel or Apple or investing in cryptocurrency. It's a very conservative mix. And so you have that investment mix, you have the actuarial mix, and then that there's a formula that goes into all that, and that's where the rates come from.
Thanks, Joe. Very, very helpful. I'm sure it's a very complicated but fascinating process for you and the board to go through.
Fortunately, I don't have to do the nitty-gritty. The actuaries do the nitty-gritty. So
good that we have those kinds of people who could do that sort of work. So a question we've received is, do the gift annuities that are received go into the Highest Foundation endowment and set up an income stream to Highest for general operating? And the answer is yes. So the residuum that the foundation receives when we receive the end of the remainder of the annuity, when the donor passes, comes into the Highest endowment. And annually, we allocate to Highest, at the moment it's 5% of the total value of the endowment goes back to Highest every year. So the answer is you fund an annuity, should live long, happy, healthy lives. At the end of that life, what's remaining in that annuity account then passes to us for our use and is invested in the endowment. So since we have just a minute or two left, Joe, thank you so much for your presentation, for the creativity that you shared with us this afternoon. We do have our next webinar coming up on Thursday, April 18th. Also at noon Eastern, which will focus on 8 ways to personalize your legacy, thinking about all the different creative ways that people can make a gift during their lifetime or through their estate plans that both support the Highest Foundation and of course Highest, as well as provide some sort of benefit to you as a donor, both to your heart and soul for supporting our work, but also a tax benefit to you as well. I just want to say that we at the foundation are grateful to you, to those who've joined us today, for your time, for your participation, for your financial and philanthropic support. And we're here to partner with you. We are your partners in helping you shape your philanthropic legacy now and into the future. So thank you so much for your time and energy. And please do reach out with any questions. We're here to help, and we're happy to do so. Thank you, everybody.
thank you.
Take care.